We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. The US government shut down, data went dark, and yet Wall Street rallied. Bad news turned into good news as investors doubled down on rate cut bets after weak private payrolls data. Tech and small caps surged, oil plunged over 7% after OPEC Plus signaled higher output, and gold hit a record high above $3,900 as Bitcoin soared past $122,000. In Europe, stocks reached all-time highs on US rate hopes, despite sticky inflation. Japan's central bank edged closer to another rate hike as yields climbed, and in China, markets rose ahead of Golden Week. But the recovery still leans more on sentiment than fundamentals. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
Our mission today: cut straight through the noise in global finance. We want to give you the real insight on how world stock markets just hit record highs.
Right.
While, the U.S. government literally shut it. And it's this huge paradox, isn't it? Risk assets soaring when things look, well, chaotic.
It makes sense, though, if you know where to look. And the key this week was this really aggressive bet on one thing. Rate cuts are coming, and soon. Investors basically took bad news job losses, a shutdown, and said, okay, this forces the Fed to act.
Front-running the liquidity wave.
Exactly. It was like a masterclass in market anticipation. So we need to dig into why that bad news felt so good for markets, and maybe more importantly, where this whole thing could fall apart next week.
Absolutely. So this is your guide for the next 7 days. We're going region by region: U.S., Europe, Japan, China. A really sharp breakdown. Then the calendar you need and the top 5 risks to watch, especially if you want to protect those gains. Let's start with the U.S. That's where the contradiction feels strongest.
Yeah, look at the scoreboard. S&P 500 up a solid 1.09%. NASDAQ even better, up 1.32%. Tech leading the charge.
Classic liquidity play.
Pretty much. The thinking is clear. Weaker economy equals faster Fed action, and that money tends to hit high-growth tech first.
And was there one specific piece of data that really flipped that switch, that took us from sort of cautious to rate cuts are definitely happening?
I think it had to be the labor market weakness we saw. The ADP private payrolls report, that was one we actually got, and it showed a real contraction.
Not just slowing down, but shrinking.
Right. The U.S. private sector lost 32,000 jobs in September. That was way off expectations people were looking for, like a 51,000 gain. So yeah, a big miss.
Wow.
And it's the first time in months the job market looked genuinely weak. For investors, that just immediately changed the question from, will the Fed hike again, to, okay, how soon until they have to cut? That's the takeaway, really.
But then there's the immediate problem, the big elephant in the room. The U.S. government shutdown, just when we need clarity. Silence.
Exactly. Government shuts down, data stops flowing. The Bureau of Labor Statistics, silent. That means no official September jobs report when we expected it.
And maybe no CPI either.
Potentially, yeah. The inflation data could get held back, too. It just creates this huge information vacuum right when we need the info most.
And that vacuum gets filled with, what, just guesswork? Which is a massive headache for the Fed going into their October meeting. You've got, what, 750,000 federal workers off the job?
Right, adding immediate drag.
And the Fed itself is losing its main tools for reading the economy.
Precisely. They're kind of flying blind, without their usual dashboards. And that's probably why Fed officials sounded so all over the place this week.
Yeah, I noticed that. Goolsbee in Chicago worried about sticky services inflation.
Sounding pretty hawkish, yeah.
Well, Logan in Dallas was talking about a slower normalization path. More dovish.
Totally different messages. Investors see that, and they know the Fed's likely working with old data, so any guidance they give, you got to take it with a huge grain of salt right now.
Okay, let's shift to market signals because commodities were sending some wild messages this week, really contradictory stuff. This feels like where the liquidity story bumps into reality.
Yeah, this divergence is super important. Look at oil, WTI crude just plunged 7%.
7%. Wow. Why?
That was OPEC plus suddenly deciding to boost production plans. Unexpected. So boom, that cools off headline inflation worries instantly.
Okay, deflationary pressure there.
But then,
Look at gold. It surged over 3%, hit a new record high above $3,900 an ounce. That's a classic move into safe havens, assets that like uncertainty and cheap money expectations.
hold on. Oil tanks on supply news. But copper, Dr. Copper, the industrial health signal rallied over 7%.
Yeah.
And gold screams safety, but Bitcoin, maybe the ultimate liquidity bet, jumps 11% over $122,000. I mean, how do you square that circle? What's the main driver when you see signals pulling in opposite directions like that? It tells me the main driver is liquidity, not really solid industrial demand right now. Copper's rally, yeah, that signals some optimism about the future, maybe China reopening hopes or something.
Okay.
But the huge jumps in gold and Bitcoin, that's investors betting the central banks are about to open the tax, flood the system, so the market's fragmented. You've got industrial bulls buying copper, liquidity bulls buying gold and Bitcoin, and everyone's dumping oil because OPEC Plus turned on the spigots.
So the U.S. takeaway,
Yeah.
that bad news is good news trade, still very much alive. But this data blackout from the shutdown creates this massive uncertainty bubble around the Fed's next move. Okay, let's pivot. Europe. They weren't just along for the ride. They were hitting records. COXX, Europe 600, up almost 3%, hitting an all-time high. Did Europe actually earn that, though? Or is it just, drafting off the U.S. rate cut hopes?
I think it's heavily leaning towards the drafting effect, the coattails. Expectations of U.S. cuts usually weaken the dollar, and that tends to be good for European stocks. But domestically, Europe's got its own sticky situation.
Sticky how? Inflation.
Yeah, inflation isn't playing ball quite like it is in the U.S., or at least how the market wants it to. Eurozone headline inflation actually ticked up a bit in September to 2.2%. And core inflation, stripping out the volatile stuff, that just held steady at 2.3%.
So no clear downward trend there.
Not really. It's proving stubborn, which kind of limits what the ECB can do.
Right. So how's the ECB reacting? Is Lagarde sounding worried given that sticky inflation?
Actually, no, quite the opposite. Lagarde sounded pretty calm, said inflation risks were quite contained. Her message seemed to be, look, rates are high enough now, we're well placed to respond if needed.
So basically signaling they're done hiking, but definitely not ready to talk cuts.
That's the read, especially when you see unemployment there also ticked up slightly to 6.3%. The slowdown is starting to show up in the jobs data, too.
Okay, and quickly, across the channel in the UK, housing market looked confusing.
Deeply mixed, yeah. Mortgage approvals fell after a few months of gains, suggest buyers are maybe getting nervous about borrowing costs again.
But prices went up.
But house prices actually rebounded, up 0.6%. It's just a messy picture. Some resilience, some softening. No easy path for the Bank of England there either.
All right, let's head over to Asia, starting with Japan. They're dealing with their own massive policy shift. Markets were mixed there this week, Nikkei up a bit, topics down more. It feels like all eyes are on their bond market still.
Absolutely. The normalization train is picking up speed, and you see it in the bonds. The 10-year JGB yield, Japanese government bond, it jumped significantly to 1.67%.
Which sounds low, but for Japan.
For Japan, it's huge. They've kept that rate pinned near zero for like a generation. That jumped to 1.67%. That's the market actively pricing in the end of their ultra-easy policy. Not just eventually, but like now.
And did Governor Ueda give any signals to back that up? He's usually pretty careful.
He was pretty direct this time. Reaffirmed that rates will rise if the economy and prices evolve as forecasted. That's about as clear as the BOJ gets.
Removes the ambiguity.
Exactly. And the market heard, get ready for a hike before year end.
And the immediate impact on the currency.
The yen strengthened quite a bit, down to 047.3 per dollar. And a stronger yen, well, that makes Japanese exports more expensive. Puts pressure on those big global companies.
Right. So tighter financial conditions starting to bite there, potentially hitting stocks outside of maybe specific areas like AI leaders.
That's the dynamic. Investors are factoring it in.
Okay, let's wrap the tour in China. Short week there before their huge Golden Week holiday. Hang Seng looks strong, though, up almost 4%. Are people buying a real rebound or just betting on holiday spending?
I think they're buying the hope from the holiday, mostly. Everyone expects this massive surge in spending during Golden Week. Travel, shopping, eating out. It's seen as this crucial test, you know? Can households finally open their wallets again after months of worry?
But the underlying data, the factory activity, that still looks pretty weak, right? The engine isn't really firing on all cylinders yet.
That's the key thing you got to remember. Manufacturing PMI, it ticked up, but only to 49.8, still technically contracting.
Yeah.
And non-manufacturing services just slipped right to 50.0.
Yeah.
Flat.
So zero real momentum outside this holiday boost hope.
Pretty much. The whole advance feels like it's hanging on Golden Week delivering. If those sales figures disappoint when things reopen, you'll see commodities and other Asian markets feel that pain pretty quickly.
Okay, quite the global picture. Lots of contradictions. Let's look at it now. What do you need to have on your radar for next week, October 6th through the 10th?
Right, calendar time. For the U.S., Wednesday, October 8th is key. That's when we get the FOMC minutes from their last meeting. It's really the only official look inside the Fed's thinking we'll get before the next decision.
And assuming they get released, given the shutdown?
Big assumption, yeah. That's the caveat over everything U.S. related. We're also scheduled to get trade balance, consumer credit on Tuesday, and definitely watch the weekly jobless claims on Thursday. That might be our only timely read on the labor market.
Okay. And Europe.
Yeah.
They need to justify that rally.
Exactly. Monday brings Eurozone retail sales. Then Tuesday, German factory orders, and Wednesday, German industrial production. These are crucial. Weak numbers here could really pop that STOXX bubble.
And Japan.
We get household spending on Tuesday, current account on Wednesday. Strong numbers there could just pour fuel on that BOJ normalization fire, push yields higher.
All right, now for the really critical part, the top 5 risks, the things that could absolutely derail this rally next week. What's number 1 in your list?
Number 1 has to be Fed path whiplash amid data blackout. Simply put, the market has priced in a lot of rate cuts, maybe too many, too soon. If those FOMC minutes on Wednesday sound even slightly less dovish than expected, or if any labor data surprises to the upside.
That bad news is good news. Trade flips hard.
Violently. And remember, the Fed itself doesn't have the full picture because of the shutdown. That just increases the chance of a market misread or overreaction.
Okay, risk number 2.
Energy slide versus inflation mix, that 7% drop in oil. Good for headline inflation, yes, but it hurts energy companies, energy debt, so that the risk is twofold. Maybe oil keeps falling, tightening credit in the energy sector, or maybe it snaps back sharply, which immediately restarts inflation worries and puts the Fed right back in a tough spot.
Got it.
Number 3, Eurozone growth pulse disappoints. That European rally needs proof, period. If German factory orders or industrial production this week come in weak, it just confirms the rally was all about U.S. liquidity hopes, not local strength. That could trigger a sharp sell-off there.
Makes sense. 4th risk, back to China.
Yeah. China Golden Week spending underwhelms. This holiday is the big Q4 test for consumer confidence. If the spending data that trickles out is weak, it signals the Chinese consumer is still saving, not spending. When their markets reopen Thursday, expect pressure on commodities and emerging markets across Asia.
And the final risk, number 5.
Japan yields spike and BOJ timing. We saw yields rise and the yen firm up. That is tighter financial conditions. If data like household spending on Tuesday comes in strong, it just accelerates the BOJ's path towards hiking rates. Maybe even before year-end, that puts more pressure on the yen, on borrowing costs, and could really stall Japanese stocks and maybe broader markets too.
Okay, so summing it all up.
Yeah, to synthesize, the whole global market right now seems laser-focused on just one thing, the Fed pivot. It's kind of ignoring everything else, even a U.S. government shutdown. Risk appetite is surprisingly strong, all driven by this belief that economic weakness is actually good because it forces the Fed's hand on liquidity.
So the market needs bad news to go up.
Yeah.
That feels unhealthy.
And very vulnerable, if anything, positive surprises.
Yeah.
But here's the final thought, the question you really need to wrestle with next week. Given how much markets need bad news right now, and this growing data blackout in the U.S., how much actual reliable information will the Fed even have to make a credible decision later this month?
That lack of clarity, that's the real uncertainty you need to factor into your strategy right now. Use this insight, sharpen your plan. We'll be back next week to help you navigate whatever comes next.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format. AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.